happy that you're here, Frank. Don't you understand? We just want
I
you to
do.
show us your charts.
Well, I can definitely do that. Well, first, let me say thank you so much for the invitation to participate in such a fantastic and informative and really a unique event here. It's been a pleasure to be part of it. I was there as a observer last year, and it's great to be a participant this year. So, just to start off, to give a brief introduction, I've been working on Wall Street now since 1997, and I started here at Instinet, the Mora company, actually the week before the internet bubble burst in 2000. Never forget it. So what was interesting, to me or anyone else that got involved with technicals back then, was that from the few years before 2000, being overbought was the best thing possible. It's kind of like now, and obviously that changed as soon as I basically stepped on that trading floor back then. And from 2000 until now, I've been sitting on a trading desk, and currently I'm both a senior equity sales trader and the firm's head market technician. And so because of that, I do talk to a lot of different people in different roles. And it's very similar to Dan Russo, who was on earlier. My clients are institutions, hedge funds, large asset managers. So my audience range is pretty wide. I speak to buy-side traders, analysts, PMs. I also work pretty closely with our research sales team here, our research analysts as well. So that means I need to focus on multiple time frames because there's a wide appetite for a lot of different trends, as you might imagine. So let me kick it off. Now, you may be wondering why the title of my presentation is such, why is technical analysis the blockchain of investing? Take 2 minutes to get to that, and I think you'll understand why pretty quickly. Let's see. Sorry, 1 second here. Let me get to that. There we go. See that now? Oops.
You're looking
Sorry,
good.
technical difficulties here. All right, let's go back to that one. All right, so there are 1,500 cryptocurrencies, millions of speculators. Now, this is just 20 of them. Now, I don't know about you, but I didn't recognize any of those before. Something called Opus, Syndicate, so forth and so on. So that means there's millions of speculators out there. There are also millions of explanations for these coins and the price action because of them. And I think, though, the underlying concept of blockchain seems to be accepted as the thing that's going to drive all of this going forward. And the reasons are just because it can be applied to so many different businesses from different industries across sectors. So really the possibilities are endless. And these are just a handful of some of the firms that have been starting to look at ways to put that into their system and obviously make their business more efficient. So because of that, it's a growing asset class. And obviously last year was a huge bump up in market cap. And when I first looked at this page, it said 100 billion, right, was the market cap. Now we're at just about 550 billion. And we can see that across the other asset classes as well, right? The different bubbles show how it lines up to both asset classes that we know and love and also some wealthy individuals as well, which I thought was kind of funny. So with that comes the want and desire to speculate and invest. And we see that from both a retail perspective and also institutional perspective. And so these are the main hedge fund strategies that have been around for a long time. They've proven to be successful. They've made investors millions and billions of dollars. But if you think about it, any one of these, you just take a quick glimpse, how many of them really were helpful in the cryptocurrency market, especially last year? I would argue not too many, maybe not any at all. And so one of the things that has helped, of course, in the very beginning is analyzing price and technical analysis. So why is price so important? We all talk about it all the time, but why is it? The reason is, in price there is knowledge. And that, of course, a very simple and very powerful term was first said by Alan Shaw, who ran Smith Barney or Citigroup technical analysis area for 46 years. And as a side note, Alan was also my first boss. And you can see how much of an effect that had on me still in this business now for 21 years later. So, if you think about it, just to bring the title back into this, just like blockchain can and will be used to make thousands of businesses across various industries more efficient, technical analysis can be used and has been used to analyze any asset class. We don't care when the asset class began, if it was 100 years ago or 5 years ago. As long as we can chart it, we can use the principles that we've been talking about today to help. And so the reason is because a trend is a trend, right? And so when I've talked about Bitcoin over the last year or so, I've tried to relate to other asset classes that people understand and see every day. So this was just from a piece from late November that I entitled "The Tale of Two Uptrends," where you have Bitcoin and S&P are next to each other. Now, of course, Bitcoin is priced in log scale here, and S&P is in linear, but I mean, at first glance, they seem pretty similar, right? The major difference, of course, is that the S&P was able to do its ascent with basically no volatility, while Bitcoin was nothing but volatility. But in terms of the ebbs and flows and the respect of the lines on the top and bottom, it's obviously just the same kind of asset and the same kind of trend that we've seen many times before. So let's get into the real analysis, and I'm going to go through a number of different asset classes and areas, and I want to just continue with Bitcoin for now. We'll move on from there. So Bitcoin last year, obviously in the news, many people on this call I'm sure did very well in it, and I also believe that everyone did probably a little bit different in terms of their strategy. This obviously Bitcoin does not close, and so it has liquidity, and it probably causes a lot of people to want to trade this in a very short time frame too. But the way I was looking at it and the way I was trying to express it was that if you're following trends and you're a trend follower, then there were two key things that Bitcoin did in 2017 that were able to keep us in the game. Number one, the rallies all respected or came close to respecting the 61.8 retracement level, and the ensuing bounces or rallies all were able to make new highs and break out. Sounds pretty easy, right? But think about how much volatility we had to go through to get there. But time and again, we see all four of those charts that happen. Look at the green arrows for each one, right? And so that happened beginning of the year, middle of the year, and then we take it all the way to the end in November and December. Now, that rise, of course, was extreme, from below 10,000, wherever you want to have a starting point, to all the way just near 20,000. And the initial pullback, though very severe, where that green arrow shows there on the top, it did come in contact with a 61.8 initially. I was surprised to see that just because of how much of a severe downturn it was, but it did rally. Fortunately, we had the first lower high, and then a series of lower highs along the way, so that meant that things had now changed. So that's fine. We're still up, obviously, a huge amount from the beginning of 2017, but again, we have to recognize when patterns are in existence and then when they change. So right now, one potential scenario that could come into play, again, looking back to that upper sloping channel that 2017 gave us, even before the move in November, December, this was an extreme move. And then, but what happened afterward with the advent of the futures exchanges opening and Coinbase exploding in terms of membership, it just got obviously much more than it can handle. So even if we don't go back above that upper threshold, you still see how this could maintain the uptrend that started at the beginning of last year and eventually get back to higher levels. All right, so the stock market in 2018, January, what phrases come to mind? We'll keep it politically correct here. Overbought, we've heard that before. We know they can last for a very long time. Maybe overdue for a pullback, overextended, or for our friends that focus on fundamentals, overvalued. But in reality, I look at stock market now, and as it has been in the past, the collection of risky assets. And so we are willing to go into risky assets for the ability to make, obviously, a return over something that doesn't have risk, right? Whether you call that the risk-free rate or maybe inflation. So inflation clearly been in the news because of what's been going on in the economy, what potentially can happen with interest rates. And if you think about that, the most mundane piece of economic data we may get every month is CPI, right? We're up maybe 0.1%, 0.2%. So it's largely just, brushed aside as, okay, fine, we're still heading in the right direction. But over time, this is what the CPI has done. New StockCharts.com data, off about 1,600% over 100 years. Now, again, we're talking about 100 years, not a year that we're used to seeing in cryptocurrencies, but I mean, this really drives home how that works. And we really hope that our ancestors back in the 1920s decided to buy an inflation-protected bond instead of bury the money in the backyard. That would have made a difference for us, right? But the key is that risky assets increase in value over time, just not all the time. And that's a key concept to think about, because when we look at the S&P 500 now, going back just about the same length of time. And so, you know, a few things stand out here. Number one, we are up a good deal. There's just a continued uptrend. We know assets go up over time, but this just shows us exactly how much from a log scale. Now, the other thing, which I think is very important to consider now, is that there were multiple consolidation periods that lasted multiple years, sometimes decades. So, you know, the big argument now, JC, I know you've been talking about it a lot, is that, you know, should we measure this uptrend, this bull market from the '09 lows or from a most recent breakout point? So if we measure it from the breakout point, we can see how that relates to times in the past. We had a 25-year breakout back in 1954. We had an 8-year breakout in 1982. And we had a 13-year breakout in 2013. And this is how those moves compare during those breakouts. So we're talking about, remember, the market didn't move a lot before each one of these breakouts. Just, you can just imagine how many people were calling for a double top back in 1954 after not, you know, going through the depression. But even after that, market was up 280%. From 82 to 2000, 1,000%, and now we're up about 90% from 2013. Still a lot. But again, we got to keep things in perspective, especially now when no one really knows what to do with these consistent new highs. So this third multi-decade breakout, by this perspective, is the smallest of the bunch, and it's also the shortest, right? You got a 19-year extension, excuse me, an 18-year extension, and a 5-year extension. So is every time different? Yes. But did we just break out from a 13-year base? Yes. And we're 5 years into that extension, and that's where the previous ones. So we can only use the data that's been there. You know, stock market as a publicly traded index has, you know, not been there longer than 100 years, so this is what we have. So what's the problem? So I like to call this conundrum of epic proportions. Now this is interesting. I pulled these headlines and these bullet points here for a presentation I was invited to for the CMT Association in early December, and I was going to update them, but then I figured, you know, it's interesting to see what was being said in early December, even late November, compared to now, since the market is even more extended at this point. Even back then, you know, it was being doubted. We're talking about, you know, New York Post was writing stories about traders leaving to go to work at technology companies. There was talks of a bubble, and my favorite one was the article on the bottom there, talking about this real bull market staggering onward, right? So we have to, again, pay attention to price, not what's in the news. Now, a few more examples to put this home. Now, I'm sure we've all played this game recently. Stock market bubble. Type it into Google Trends, and we get something like this. Not surprising to see that that term is one of the highest it's been searched for since the data was being, you know, first counted in 2004. You know, we hear about it every day. If the press tells us it's a bubble, then people are going to search for that term. But, you know, looking back to those previous charts, we also know the reason for us being in a potential bubble is that the market is in an uptrend. So if we played the same game and typed in stock market uptrend, you would think that it would be at a high as well. Now, JC, you're going to love this. This is the result that we get if we type stock market uptrend in Google Trends. Your search does not have enough data to show here. So I guess that means that not a lot of people are searching for it. And, you know, everyone can try this on their own, but it has not come up with anything. So, again, another way of looking at this. So this is a chart of the volume, New York Stock Exchange and other volume on a 10-day rolling basis compared to the IAI broker-dealer ETF. Volume is unimpressive. We know that broker-dealers really aren't doing great in terms of equity volume. You know, we know also that the IAI has been one of the best performing groups over the last 2 years out there, right? And it's filled with exchanges and broker-dealers. So are we going to pay attention to the news, or are we going to pay attention to the price action and try to profit from it? And we can see this even further in the stocks of the most popular global exchanges. Again, these are the publicly traded stocks in their ordinary exchanges there. So the NASDAQ, NDAQ, the stock of the Brazil Stock Exchange, Hong Kong, London, so forth and so on. We see how this is going. And again, I started looking at this at the end of, before this year, and then refreshed them just last week. I couldn't believe at how much more they've gone up. And so again, this is a global thing. We all talk about it. We all know that the fact that the market is being supported by so many different areas, right? It's global, it's style supported, so forth and so on. And so just to take a step in terms of workflow too. Now, everyone has different things that they look at. For me, it's very difficult sometimes to keep track of everything during the course of a day. There's many different trading issues and responsibilities to have to adhere to, and that's fine. So, and I think anyone on this phone who's just starting out, there's a tendency to get overloaded with information. So in terms of instead of going out and searching for those terms, we should try our best to have what we want given to us the way we want to see it. Curate it as much as possible. Everyone's going to see things differently. We see this now from a number of the presentations today. There have been some similarities, and I'm sure I'll hit on a few things that others have as well. But in reality, you have to view the world as it makes sense to you. So what I started to do was track now up to 170 different ETFs within different categories. So there are a few of them there, but I also look at style, currencies, commodities, foreign markets, fixed income, so forth and so on. And the other thing that helps me, maybe remedial, but it does help me, is to just color code areas that are similar. So in my world here, the blue equals technology, right? So if you just look at this quickly, hopefully the blue stands out more than anything else. That will tell us that from the low in February 2016, technology has done pretty well. We see that in U.S. Markets and the X100 up the most. Both financials and technology have done very well. We'll touch on the financials a little bit more. And also, many of the industry groups have done great. And then looking at the top 10 performers of the S&P 500, just unbelievable amounts of return in 2 years. So semiconductors, let's focus on that. So semiconductors have been in the news for a while in terms of market leadership. And this is just the performance chart of the semiconductors SMH ETF compared to technology, the XLK, the NDX in green, and the S&P 500 in black. And I don't have it charted here, but the collection of the 5 FANG stocks together are 123%, and that's interesting to consider because Netflix is up over 200%. So it's largely due to that. So they've been leading, and we know a lot of the major stocks there, but there are a number of them that we probably don't know of too much. Those were the real leadership names, and I really believe that we have to track them to see if they can continue to go higher. Now, looking at that from an absolute perspective, going back to the beginning of 2017, this is a log chart, and the SMH has adhered to this upper sloping channel the entire time. It's on occasion got overheated, and we see that is identified by the red arrows. It's caused at least a pause a number of times, and some of the pullbacks that have been more severe have caused the SMH to visit the lower level of this channel, and that's when met with demand. So that looks very clean and good from a weekly perspective. But a lot of us are sitting through all of this, and from a very closer view, we see the price action go through every day, and it's much more severe. So these 4 charts are just views of a rolling 6-month basis, and we see of all the different pullbacks that have happened within the SMH. There are 11 different pullbacks of at least 4% that the SMH has endured through this entire uptrend. And you think about it, again, this is a leadership group that is up 130% and has gone through more than a handful of very big drawdowns. So again, this really has to do with what your time frame is. If you're a short-term trader, you're most likely got stopped out a lot of these more than once. If you're a long-term trader, you understand that something like the semiconductors are volatile, and you can endure something like this as long as those pullbacks are contained within the channel that we looked at above. And within the SMH, there are numerous stocks that have similar looking patterns, even the ones we know about. But I would look even further to see just how big of a drawdown some of these names have, right? Look at AMAT. Had a bear market in December. Anyone remember that? Down 21%. You say the same thing almost with NVIDIA, which takes its punches but comes roaring back, this past time included. Again, so these have gotten maybe a little closer to the lower thresholds of those upper sloping channels over the last few weeks or so. But again, they continue to hold from that perspective, and that's what we have to look at. Now, even within the best groups, there's going to be laggards, and we have to identify them and realize that there's so many other opportunities out there. Why are we going to wait around for something to bounce just because we think it has a good chip or it has great prospects for whatever reason? That may be true, but there's a reason why these two stocks, MTSI and SWKS, have not participated. I don't know what they are, but I just know that they continue to underperform in the best group. So why try to take a chance until something changes? Okay, so getting back to, let's bring financials back into this picture. So we know that financials have done the best since the 2016 lows. Now going back to the 2009, both financials and technology, and obviously many others, have done well. But look how close this performance is from both of the technology and financials. And we know that's interesting because we've been in a rate environment that's been heading lower and lower. So let's take this back even further. Going back basically 20 years now. So I'll explain what's going on here. So the blue line is a relative line of the financials divided by technology. Red line, of course, is the S&P 500, and then down below is the 10-year yield. Now, what we see quite vividly in yellow are the two market crashes, the internet bust and boom and bust of 2000, 2003, and then the financial collapse of 07 to 09. So we know that it was technology's fault, or they're the biggest victims, however you want to look at it, in 2000, and then, of course, financials underperformed everything in the second one. Now, the point there is that because one of the biggest sectors each time had problems, really big problems, the S&P 500 and the major indices really didn't stand a chance. You see that the S&P just got obliterated. But look at the other times though. From 03 to 07, and then from 09 to 2018 now, S&P enjoyed a huge run, both times, obviously even more now. And look at that blue line, that relative line. Does anything stand out? To me, it does not. It looks more like an EKG reading than anything else. So that means that financials and technology more or less performed on par with one another both times. So if we take this to interest rate conversation, we know that financials were able to do more than okay in a lower interest rate environment. Now, we all believe, it seems like, that the prospects are good, both from an economic perspective and a technical perspective, that yields can continue higher here. Whether how fast that takes, who knows? And the financials should benefit from that. But does that mean that technology is going to get really hit because of that? I would think no. I would think if you lay it out there, if financials do well, second or maybe even first, largest component of the S&P 500, if that does well, that's going to benefit potentially the entire market. So maybe financials will do better on a relative basis than technology, but I could really find it almost, not, I wouldn't say impossible, but it'd be very rare to see financials moving in one direction and technology moving in another for an extended period of time. So talking more about the 10-year yield, is it different this time? We've been fooled before. There's been calls for a move to 3% in the 10-year yield many times now. And so I think the most important thing to occur over the last, say, 3 or 4 years was last year when the 10-year yield came back and respected that 2% level. That was a key higher low, something that the markets had a very hard time doing. So that was able to set up, whether you want to call this an inverse head and shoulders pattern or you're more comfortable labeling it a cup and handle, we can see what has happened here. And we're getting to a point where we're breaking out, or maybe it's a few cents or so above 2.6%, and just a classic price target measurement gets us to just above 3.8%, and that will coincide with levels from 2009, 2010. So are we there yet? You know, I've seen this more than a few times today, but you know, we're dealing with this downtrend line, this downtrend that defines all trends. And I would really like to hear anyone, if there's anyone on this call that has been through a real rising rate environment, because that's something no one has really experienced. We've seen it for a few months, maybe a few years even, but overall, it's been a series of lower highs and lower lows for 3 decades. And so even if we get to see that pop above, and those, you know, those annotations on the right there are just the same thing that you saw on the previous page. This is just, you know, shrunk down to see a little bit more action. So there's still left to be determined. So what else can we look at to help us here? Utilities. Utilities have really had a hard time recently. If you look back at the 7 weeks that ended before last week, yeah, the XLU was down actually 11%, which was the biggest pullback during a time frame of that nature since 2015. And what I have highlighted in yellow are the times when other severe sell-offs that the XLU has endured, so over the last 10 years or so. And what we see quite clearly is that each of the previous ones led to a bounce. Some of them a little bit more stronger than others, but that type of pullback did not last for a long time. And so the question is it going to happen again? So now if we take the XLU, the same chart, and put the 10-year yield on the bottom, we can, two things, right? We can see that the XLU had its best bounce as the 10-year yield crested or rolled over each and every time. And within, over the last 10 years or so, the XLU is still in an uptrend, just like everything else, really. So I guess the question is, if the 10-year yield continues to move higher now, you know, at a faster rate, and being able to take advantage of a breakout like it hasn't before, you know, is the XLU going to get hit hard? You would think that the sell-off will continue, but again, we haven't seen a sell-off like that get much worse than what we've seen over the last 11 weeks. So I think if you believe that the rates are moving higher, it just may not happen right away. It may take some time to actually get there, because something like the XLU, which people look at a lot, doesn't really break down and roll over that often. And if it does, you have to wonder what else is going to follow suit with it. So let's assume that rates are moving higher, and one area that we can agree that could benefit the most are regional banks. Regional banks are very tied to their loan business, and that, of course, has to do with interest rates. And the KRE Regional Bank is one we all talk about a lot. It has 77 different regional banks in it, and you know, as rates have been going up over the last year, we see that the KRE has done well. And on occasion, it's actually done much better than the yield, which shows that, you know, there could be traders within it just, you know, anticipating a rise in yields and just willing to put their money where their mouth is even before we see in confirmation. But the problem I have with the KRE, not really a problem, just an observation, is that, again, it has 77 components, but if you look at the Russell 2000, right, it's small caps, of course, 2,000 stocks in it, there are 400 financial names in the Russell. 200 of them are banks. Each one of those is a regional bank. So if we think about what's really going on, the regional banks across the country, they're small companies or small stocks, and that's really what's going to drive this. And so this is just a custom index I made with the help of Bloomberg. And this is all 200 of those regional banks within the Russell 2000 equally weighted. And we can see on the right there that this January move hasn't even gone above the November high yet. And so that means maybe this hasn't confirmed the move in rates yet. And maybe some investors are getting a little hesitant to think that yields can continue higher in a more material way right now. Now, the good news is that there are many stocks that look like this that are about to break out that haven't yet. So I would urge everyone to go back and look at those names. And you can easily find the ones that haven't moved yet and maybe at least set a you know, potential buy list for if and when yields do move higher. Okay, so let's talk about retail now. Retail I've been looking at almost every day over the last year or so, and it's because it's one of the few areas that had not performed well. And it's, you know, it's been a tale of two periods for retail. We see what happened from January to October 2017. The XRT was down 9%, grossly underperforming the S&P 500. We see that on the bottom there. And then since that point, up about 24%, just a huge amount of outperformance. So which one should we trust? Well, let's not forget about what was going on the previous 3 years. Now, this is undeniable head and shoulders reversal pattern. And I remember starting to talk about it and highlight it to clients back in actually the spring of 2016, when the head and shoulders pattern was really not as substantial. And so through the course of 2017, we know that the overriding theme was that Amazon was going to take out companies one by one, and for a while it did. But every time that neckline held, that told us something. Even though there were some stocks just getting completely eviscerated, there must have been some demand for some areas to suggest that this wasn't breaking down. So it continued to hold and hold until the end of the year when we finally had a humongous rally. Now, we didn't know that was going to happen, but it did seem interesting that if you talked to anyone and asked what you thought the XRT would look like, no one I don't think many would have realized that it was continuing to hold a line for the last 4 years. And so what also I've been looking at throughout the course of this reversal was that from the beginning of the year, and you always try to look for patterns that can potentially change. And so there are many short-term low bottoming formations, you want to call them head and shoulders patterns, whatever it was, that took place. There's 4 of them really that got constructed up until the fall of 2017. And I think it's important to track these, even if you're not a long-term investor, because patterns can tell you things even when they fail. Obviously, one that breaks out will tell you that it's potentially a big-time reversal. One that fails just continues to tell you that the stock or ETF is in a downtrend. And so when the one in November happened, it was smaller than the other ones, and I kind of annotated it reluctantly because it was like, we have to track this again. It's not going to work out. And then we had a huge breakout, and then the next day was that gap higher. And then from that point, the consolidation period after consolidation period, breakout, breakout, breakout. And so we can see how quickly it changes. And again, we have to continue to track these smaller patterns that can give us an idea of how powerful the trend is in the other way. So another thing, and I haven't talked about RSI in a while, but I do track it. And we did see back in summer to the autumn months there that we had some higher lows. Well, the most important thing for me was that after this run-up from October to the end of the year, when the XRT was up 20%, how was the XRT going to react from a momentum perspective here? Previous rallies we've seen strong over the last 3 years all got the RSI above 70, but it was quickly reversed and back down to overbought levels. Back down to oversold levels. This time, though, it hasn't happened. In fact, I would argue that the RSI pullback is one of the strongest we've seen across any sector right now or industry. So we have to see, obviously, that's going to be important going forward. So we have a potential bottoming process here instead, right? This actually didn't update from December, but that's basically above both of those trend lines right now. Now, we talked about XRT being in a bottom and trying to claw its way back. Well, let's look at this from 12-year view. Maybe the XRT, what's done is just one big high-level consolidation. And this is an updated chart, and we can see that we're at the very top of the consolidation period, as in the very bottom, that line is just the XRT versus the S&P 500. So we could have a huge breakout there. I won't say huge, but once it happens, momentum is going to be searching for areas that haven't gone up in a good amount yet. Biotechnology as well. Now, 2 things about biotech is that there are 2 widely followed ETFs, IBB, this one, and also the XBI. The XBI, a lot of people look at, it's equally weighted. It already broke out. That's fine. I would say you can look at both of them as long as you know why you're looking at them and how they're constructed. So with the IBB, 10 of the biggest stocks make up more than half of the index. So it's really going to be about these 10 stocks. So with the IBB not quite at its highs yet, it means that some of these are still struggling to get back. But we saw that breakout in June. It was a huge weekly move. It was able to, again, hold that 100 level the entire time, which gave it the ability to come back so strongly, and I still think it has some room to go. Failed patterns. We've seen many failed reversal patterns in numerous areas last year. Most likely, you remember that NDX, head and shoulders reversal pattern potential in the summer got reversed, and it was up making to new highs very quickly. IBV was quite similar. Now, that happened at the end of last year, and may have been missed by a lot of people because at the time, biotech wasn't doing that much. It was underperforming. while everything else was, in the nascent stages of this melt up. And IBB was just taking its time, broke through that uptrend line, but then held, again, that 100 level. And then we saw it happen since. So failed patterns are sometimes more powerful than bullish patterns when they actually don't work out. Again, this looks quite similar to what we were talking about with retail. Now we're potentially in a huge bottoming formation. Or is it a high-level consolidation pattern, just like retail? So again, a lot of these areas that really have been under the radar because of outperformance are just trying to come back, and they could be the next leadership group. Keep an eye on that. And of course, the rest of healthcare is doing great. So this could be just IBB's turn within healthcare to take the lead. Commodities, go quickly here. I know we're a few minutes away. Just a huge move upward. This is a DBC. It takes into account many different energy and what have you, other sectors. And again, it's in the top of the channel, which has coincided with weakness in the past. So maybe it needs to take a breather. But this is what it looks like from a long-term point of view. A very identifiable cup and handle pattern with a target up near 22.5, and that would even be below the first Fibonacci retracement point from the 08, 09 top all the way down. So again, a big move already, but as it buys its time and regroups a bit, potentially, we still have this to look forward to. Okay, the dollar. Well, some things are confusing. I'm not going to make the case that this is clear to me. I really thought that, back in September when the dollar was getting close to 90, that it would turn, and it did for a few weeks, but then came right back down. And commercial hedgers are a good thing to track. And again, the question is always this: do you trust the price or do you trust the sentiment? Because the bullish sentiment in the commercial hedging community has been the highest since 2014. 2014, you can see back there, was where the uptrend line held and a huge 30% move resulted. So it's something we have to look for and see if this next uptrend line holds, but the sentiment is extremely low in terms of what it can do based on the failed bounce from last September, I would say. But that is going to have a lot of influence on the rest of the US and of course Europe. And European financials have been on fire from an absolute basis as well. And it's been breakout after breakout, holding that uptrend. This is the EUFM. So the question is, can this continue? And can it continue on a relative basis versus the XLF, the US version? So this looks quite different, right, from this perspective. We saw how well it was doing. This now is EUFM, excuse me, versus the XLF. And it's trapped in this downtrend line that's been in place since 2010. Now it's had a good run recently, but again, I don't have to explain how important it is from a currency perspective for this to actually outperform. Financials could do well, but the EUFN trades in the U.S., but its holdings are all foreign banks priced in their local currencies. So if the U.S. dollar finally finds strength again, and we can see it's still in an uptrend from 2011, if that continues, then the underperformance from the European financials versus the U.S. may continue as well. Don't forget how great our banks are doing. So something we have to look for. All right, last two charts. We're on time, luckily. S&P 500. We're looking at this from many different angles, and going from top left over to the right. This is the most recent channel. This basically is all of 2018. This is a huge uptrend, and we continue to be in it. And it just, no matter what you think about it, that trend continues to hold. But that same channel, if you go now to the August 2017, the start of this other channel, is basically this entire extension above that 5 or 6 month trend. And we can see that going forward. As we go longer in time, we see the same type of thing. We had a great run from the 16 lows, from the 09 lows, but the recent action since November has gotten just a little overheated. And so that's something we have to look for. Again, we haven't had that 3 or 5% pullback in quite a long time. So that could happen relatively soon. But we need one thing to happen to change. And that is, we need to see more or larger moves from an up and lower basis, and also more frequency. So this red line is just a number of 1% moves both up and down on a trailing basis over the last 12 months. And so we just had our first 1% gain of the year, and also since September. and that only puts it at 9. You can see that level is basically not at a point since 1960s. So the point is, if this continues, if we continue to have lower, smaller moves in both directions, this persistent uptrend can continue. I think if we see a spike in larger percents of moves, larger moves, that's going to tell us the volatility is back and we maybe finally get a pullback more than 2%. And that's it, my man.
That was awesome. That was all. I'm saving this last picture of the sentiment one. That's a great shot. So in this case, what specifically are we looking for in case of you said that we should expect more than a 2% move, which is, by the way, like 550 Dow points or 600 Dow points or something. Just for the record, in case for you people doing the math at home. But what specifically, we're going to start to see this ratio start to go up, essentially?
I think we have to at some point. See, the issue is that people keep on talking about volatility not being there, and the only widely filed mechanism for that is the VIX. But the VIX only will measure volatility on the downside. So, say we have a 2% decline or 2% decline on Monday, so you walk into that. The VIX is going to spike. But if we have a 2% advance on Monday, the VIX is going to go lower. But from my point of view, there's just an equal amount of emotion tied to that type of move that should be tracked. So even if we have larger amount of up moves over the next few weeks, I think that will set us up for a more material pullback. In addition to down moves, we haven't seen anything like that, on an aggregate basis in quite some time.
The audience is saying it's the best damn presentation they've seen in years, and I quote. That's Steve Grove. Best damn presentation. That's pretty funny. No, everybody loves it. Everybody thinks it's great, and I do too. I think it's. I think what you have to say is awesome. I think you ask a lot of the right questions, right? I think you make it very clear that you don't know the answers, but nobody else does either. So that's fine. These are the things that we're looking for that can kind of confirm that maybe we're right, or some of the things that we'd be looking for maybe for a more risk management sort of perspective. And I appreciate that. Like, that's the most important thing,
I'm just trying to follow your lead, JC. You're doing a great job, and just being able to bring everyone together like this on a Saturday willingly, that's outstanding. So thank you again.
No, absolutely, man. Happy to do it. This is great. Are you